Stevens, and today is today is a great day. We're gonna talk about we always try to look back to see what happened, and then in this office we're always looking forward to. We know what happened third quarter, what happened fourth quarter, what did we expect, and now what was the actual. So that's what we're talking about today. It's my pleasure to present our fourth quarter economic review and our outlook for 2024 this morning. Let's get started. So this morning, we're looking at, we always say that knowledge is power. We believe that when our clients are educated, that is the best kind of client. Well, we'll always try to do our best to help you. When it comes to your finances, we believe that you need to know about this stuff. One of our missions is to share with clients any knowledge that can better help them make better informed decisions. So if you look back on 2023, that the books have closed already, but it left investors looking forward to a bright and happy new year, because typically equities, the stock market is down at the end of the year. But for the first time, stocks surged in November and December, and they erased a very tough October to finish the quarter sharply higher. The last 2 months of the quarter included the Dow Jones Industrial Average breaking a record and the S&P 500 advancing for 9 straight weeks. So, y'all, we say all these big words. What does that mean? It means that normally we see November and December be down, but this year they were not. They ended on a high note, and so investors ended that year feeling good. Now, the S&P gained more than 24%, and the Dow Jones Industrial Average was up more than 13%. The year-end jump was attributed primarily to the fact that the Fed did not raise rates again. Remember, the Fed has so few avenues of how they can affect the market. When inflation starts to go up, one of the major things that they can do is use interest rates to try to get inflation back down. And so we call that an aggressive monetary position. But the last 3 times they met, they did not raise the interest rates again, which, listen, if you're paying off credit cards, you should be happy about that. Now, inflation continued to ease in the fourth quarter. Listen, it decreased. Inflation was up 5.5%. It's now 3.2%. But while it did get lower, in fact, in November, it was 3.1, and we saw it go back up to 3.4 in December. Right now, we're happy because if y'all remember in 2022, inflation was up 9.1%. Do y'all remember during COVID? Everybody was at the store every single day. If they said, we have tissue in or we have paper towels, everybody was running to the store. Well, the Fed likes for inflation to always edge around 2%. And so what they did, they were happy that it was down from 9. And they said, okay, we're going to kind of let the market ease on its own for a minute. We're not going to raise interest rates anymore for a little while. All right, so when they met in December, they said, we're not going to do anything right now, but we might raise interest. We might actually cut interest rates in 2024. We like that. We haven't seen any rate cuts yet, but remember, in January they met. They don't meet again until March 19th, which is 5 days from now. We're hoping, in their January meeting, they said, we're going to leave the rates the same. We're hoping that in their March meeting, they're gonna lower the rates a little bit. So, I know I got these really pretty charts, but I like to talk about what's going on behind these charts. When the Fed raises interest rates, it makes everybody nervous. Everything is more expensive. If you're buying a house, it costs you more because your interest rate is going to be 6.5%, right? When we bought our house, we got an interest rate of 4%. A week after we closed, the rates went up to 5.5%, and then some people are now paying 8%. We don't like seeing those rates go up. We like for them to come down. All right. And this is once again just talking about back in their January meeting, they held everything steady. We don't know what it's going to look like, but this is kind of the calendar of when they meet. They'll meet in March 19th. They'll meet again in May. They'll meet again in June. When they have these 2-day meetings, what thing it is, how is the economy doing? How is inflation doing? How can we keep this under control, right? So that is what they're always looking for. All right. Any of y'all own bonds? So here's the thing about bonds. Typically, when interest rates go up, bonds go down. It's called an inverse relationship. And when interest rates go down, bonds go up. Well, for like 3 or 4 years, no matter what happened with interest rates, bonds stayed down. It didn't make sense. It didn't follow what we're used to seeing. But finally, at the end of last year, bond prices, which are down for for 3 or 4 years, they finally had a rally. And people that are in bonds saw a positive year end. What that tells us is that the market is constantly volatile. We call it the volatility rate because when the Fed is making moves trying to get inflation, it makes people nervous, and so interest rates can change, bonds rate can change. We have to be really careful how we can't react literally every single time they do something, right? If we are investors, think about this. I'm gonna go to the next chart. Yeah. Again, this is just talking about how we look at bonds. They're called the par rate, and it's just showing that they have been down for a long time. And just to kind of give y'all an idea of how this works, listen, safety comes with the cost, and even though interest rates have risen, many major banks are still averaging low interest rates to savers. Why? Because the banks are nervous. According to Barron's, the average bank money market on December 29th of last year was still only 0.6%. And the average 12-month CD rate was 1.94. Well, I call CDs certificates of depreciation because they want you to set your money in the bank and then you get 1.94. Well, that's not a lot of money, especially when inflation is running 2 to 3%. If you're only getting 1.94, that lets you know you're behind the 8 ball, right? Okay, let's keep going. Recession fears have overall significantly diminished. All last year, all we heard constantly, recession. That's why I say, y'all, you cannot listen to the news all day because all they have is bad news. Most analysts believe that our economy is going to remain healthy and that the labor market will remain strong. They also anticipate that inflation will continue to lose steam and would decline to about 2.5% this year. These key indicators show signs that a soft landing or a very small recession, if any, appears to be more possible than what everybody was screaming last year. If you listen to the talking heads last year, they said, "Oh, get ready, get ready, get ready. We're in for a bad recession." Now, let me tell you the things that should make all of us very nervous. Right now, countries used to be all separate, right? But now the geopolitical unrest, if China catches a cold, the rest of the world gets the flu, right? If China sneezes, everybody gets a cold. If we're looking at what's going on over in Israel and over in Russia and in China and North Korea, it makes everybody very nervous. We have a lot of tension with China, and it remains a concern right now. This morning on the news, I heard them talking about TikTok, and our government is concerned that the company that owns TikTok reports data to the Chinese government. That says they are storing the personal data of the people that are on that system, right? Geez, that should make all of us nervous. And so they are saying we're going to ban TikTok. Well, there's a lot associated with that. If you ban TikTok, there are people that make their living on TikTok, right? They sell products on there, and every day or once a week, they're on there doing their products. Well, if TikTok goes away, that affects them. They have to now find a new platform, right? So all of us need to be paying attention, keeping an eye on how all of this is going to affect the stock market, right? All right. No matter what is going on in the world, we have to remember, I said earlier, we cannot throw the blanket over our heads every single day that the market changes. If you are an investor, you should be investing for the long term. Nobody should be investing to get instant gratification. I know that some people do that, but the majority of us should be looking long term. That is why we do investments that take you into the long term, right? You should be your stuff should be invested well enough where some of it is aggressive, some of it is kind of scaredy cat, some of it's middle of the road, so that when the market changes, you don't have to jump under the covers and be nervous about it, right? We're very optimistic about this year, but again, you need to look at everything through a long-term lens, and short-term movements are always unpredictable. We can't tell you what's going to happen today or tomorrow, but I can tell you if we have built a good plan for you, right? For you to get down to retirement, that plan, as long as we're reviewing it every year, your life will continue to change. Your plan needs to keep up with you. But listen, regardless of whatever 2024 brings, it's always prudent to watch your expenses and make smart money moves and investment decisions. We believe in proactive preparation, and our goal is to provide our clients with a solid financial strategy that is carefully designed to withstand any market environments. So what are our key takeaways? Inflation is slowing, but it is still a concern, y'all. We may possibly have rate cuts in 2024. We certainly hope so. It is still volatile because of geopolitical issues. And y'all, literally, there's nothing we can do about what is going on in those parts of the world. A soft landing is more likely. If we have a recession at all, we expect the analysts that look at this all day, every day, expect it to be a soft landing. We got to remember to stay the course and focus on the long term and be well prepared. All right. While 2023 was a good year, it's not a time to throw caution to the wind. as investment professionals, we still like to be prepared. Recent history has shown us that anything can happen. So once again, proceeding with caution should still be the principal notion for investors. We help our clients create well-crafted strategies and plans that are customized, that is unique to their situation. Having a solid plan includes considering your time horizon, tax implications, liquidity needs, risk tolerance, and overall personal objectives. If you have any questions about your own situation, give us a call and we'll set up a review meeting for you. We appreciate you sitting in with us. I try to keep this really short. And I always say that the best compliment you can ever give us is a referral. If you have someone you know that may need our services, please invite them to go to our website or give us a call. Our number here is 512-598-9080. Our website is jstevenswealthmanagement.com. That's JSTEPHENS wealthmanagement.com. And remember, we started doing these monthly dinners. If you remember, we started doing these monthly dinners, and I was looking, I'm trying to remember when is our next one. We do them once a month. We call them, the purpose of these dinners is really, you know, some of my clients will call me and say, Juanita, I don't know what all you do. It really is to introduce you to all that we do, introduce you to the team. Y'all talk to my team on the phone all the time. It puts a face to the voice, and invite your friends, invite your neighbors that you think might be able to use our services. So I want to thank you for joining me today, and that is all that I had for you today. All right, we have a little bit of time. If anybody has any questions, just let me know.
I don't know that I have any group questions. I have some personal questions that I can get answered later.
Okay. All right. Okay. I will see y'all next month on another call. Thank you for joining me.